Hey everyone, welcome to another episode of Mayhem in the Markets, brought to you by TraderAid.com, where we help you find your edge. First up, is positioning stretched? Systematic positioning in U.S. equities has approached levels and exceeded levels that marked the top of prior bear market rallies. Does that mean that it's over? Not necessarily, but it does mean that positioning is likely a bit stretched here. Options buyers are expecting a higher volatility index in the weeks ahead, and typically when we see this level of interest, it leads to a spike in the VIX. Will this time be different? Time will tell. But a lot of these folks are pretty savvy, and they're looking out into March and saying, well, we've got CPI, we've got a jobs report, we've got the Fed, we've got triple witching, so maybe there are some catalysts for volatility, but we also have zero DTEs, which are suppressing vol. So it'll be interesting to see what all happens here. But for now, they're expecting that VIX to rise. We'll just have to see if it follows according to their positioning or not. Home ownership remains elusive for many. We can see homeowner mortgage payments are up 26% year over year. They've more than doubled since the COVID crash. And this has made affording a home in this country and many other countries around the world, because we're seeing this all over the place, much more difficult, effectively pricing out an entire generation from home ownership. And we can see it in mortgage applications as they continue to fall, reaching levels we haven't seen since 1995. And inflation may not fall quite as fast as hoped, not just in Spain, but in many parts of the world. We've seen resilience throughout Europe. We've also seen it in the latest January CPI data. Will February's CPI data that we get coming right up be a little bit more subdued? Will we get down to 6.1% year over year? That is certainly the hope for everyone that lives in this country and buys anything, including myself. But we do have to see what ends up happening, because we're seeing some resilience in some of the inflationary forces, particularly in services. For a while, a lot of people were spending on goods as there was an inordinate amount of stimulus that reached into the bank accounts of so many. And as that $5 to $6 trillion of stimulus was spent on goods, pulling forward years and years worth of demand, we then saw a shift into services as the lockdowns abated and as COVID began to become less of a concern. And now services are remaining sticky to the upside, with core services inflation continuing to rise, something we need to keep an eye on. So I want to thank you for tuning in to this episode of Mayhem in the Markets. Like and subscribe if you enjoy my videos. You can find my work at TraderAid.com, where you can sign up for a free trial to check out what it is that we do there without any obligation. And check out macrovisor.com, a project that was recently launched that covers the world of economics, zooming in all the way from the macro into the micro. Find me on Twitter at Mayhem4Markets, and always be grateful for what you have and ambitious about what you want.